At 6:47 on a Tuesday morning, a delivery driver in Columbus, Ohio, pulls into a gas station before starting his route. He has done this same stop almost every day for 8 years. Coffee, fuel, quick glance at the numbers above the pump, then back on the road. But this time he just stares, because overnight regular unleaded jumped by 40 cents a gallon. Not because a refinery in Texas exploded, not because a hurricane hit Louisiana, not because Americans suddenly started driving more, but because of a narrow strip of water nearly 7,000 miles away. A place most Americans have never seen, many have never heard of, and almost nobody thinks about: the Strait of Hormuz, a thin shipping lane between Iran and Oman. At its narrowest point, only about 21 miles wide, small enough to miss on a world map. Yet every day, roughly 1/5 of the world's oil passes through that single choke point. That means one small disruption there can quietly ripple into the cost of almost everything here. Gas, groceries, flights, utilities, online deliveries, even your monthly rent. And that's what makes this story uncomfortable. Because for most Americans, the next spike in the cost of living may not begin in Washington. It may not begin at the Federal Reserve. It may not even begin in the United States at all. It could begin in one of the most fragile waterways on Earth. And if that water suddenly closes, the effects could move through the American economy faster than most people realize. Because the price of modern life is more connected than it looks. Most people hear oil prices and think gasoline. That's understandable. Gas is visible. You see it every time you pull up to a pump. You watch the number climb while your bank account falls. It feels personal, but gasoline is only the first layer. Oil moves trucks. It powers cargo ships. It fuels airplanes. It helps make plastics. It affects fertilizers. It influences packaging. It changes manufacturing costs. It even affects the cost of moving food from farms to supermarket shelves. So when oil rises sharply, the increase doesn't stay in the energy sector. It spreads, quietly, relentlessly, into everything. That is where the real pressure begins. And the Strait of Hormuz sits directly in the middle of that pressure. Every day, tankers carry around 20 million barrels of crude oil through that passage. Saudi Arabia, Iraq, Kuwait, the United Arab Emirates, Qatar. Some of the most important energy producers in the world rely on that route. If those shipments slow down, even briefly, global markets react almost instantly. Not because the world runs out of oil overnight, because traders price fear before shortages appear. That distinction matters. Financial markets do not wait for disaster. They move on expectation. If investors believe oil might become harder to transport next week, prices can surge today. That means Americans can feel the consequences of a geopolitical event before a single physical shortage ever reaches US shores. That sounds strange, but modern markets often run on psychology as much as supply. And sometimes fear itself becomes inflation. Imagine oil is trading at $75 per barrel. A military incident near Hormuz suddenly raises the risk of disruption. Shipping insurers raise premiums. Tankers reroute. Traders rush to buy contracts before prices climb further. Within days, oil jumps to 90, then 100, then maybe higher. Nothing has physically changed in your neighborhood. Your grocery store still has produce. Your local station still has fuel. Amazon still drops packages at your door. But behind the scenes, the cost structure of the economy has already shifted. And that shift can hit households surprisingly fast. Because businesses rarely absorb higher costs for long. They pass them on. A trucking company pays more for diesel. It raises delivery fees. A supermarket pays more to move produce. Food prices creep upward. Airlines pay more for jet fuel. Tickets become more expensive. Manufacturers pay more for materials. Consumer goods rise in price. Home heating costs increase. Electric bills follow. And suddenly a conflict in the Persian Gulf becomes a line item in a family budget in Michigan. That's the hidden mechanism. Americans often think inflation is caused by domestic policy alone. Too much spending, too much money printing, too much demand. Sometimes that is true, but inflation can also arrive from outside the country, imported through energy, imported through logistics, imported through fear. And Hormuz is one of the clearest examples of that vulnerability. The irony is that the United States produces more oil now than almost any country in history. That sounds like protection. On paper, America looks energy strong. Domestic production has surged. Shale transformed the landscape. The US became a major exporter. So many people assume a Middle East disruption should not matter much anymore. That assumption sounds logical. It is also incomplete, because oil is priced globally. Even if the United States pumps plenty of crude at home, American consumers still pay prices influenced by international markets. A barrel produced in Texas does not live in a sealed American bubble. Its price reflects what buyers worldwide are willing to pay. If global supply feels threatened, global prices rise, and American households feel that rise too. That is the part many people miss. Energy independence does not mean price independence, and in a global market, geography can become expensive. Now think about what happens if the disruption lasts longer than a few days. Short-term spikes create panic. Longer disruptions create structural stress. Companies start recalculating. Businesses slow hiring. Consumers pull back. Investors become nervous. Transportation firms adjust routes. Retailers revise prices. That is when the issue stops being about expensive gasoline and starts becoming broader economic pressure, because higher energy costs can function like a hidden tax. Not voted on, not announced, not debated, just imposed. Every household pays a little more, and those little increases accumulate. An extra $20 at the pump, 15 more on groceries, higher utility bills, more expensive shipping, rising credit card balances because essentials suddenly cost more. For wealthier families, it is annoying. For middle-income households, it is stressful. For lower-income Americans, it can become destabilizing, because the people with the smallest margins are always hit first. That is the uncomfortable arithmetic. When necessities rise, people cut somewhere else. Dining out disappears. Subscriptions get cancelled. Vacations get postponed. Emergency savings shrink. Debt rises quietly. And an overseas shipping lane starts changing behavior inside American homes. History has shown this before. In 1973, an oil embargo helped trigger one of the most painful inflationary periods in modern US history. Lines formed at gas stations. Prices surged. Consumer confidence collapsed. The economy slowed while inflation stayed high. That combination became known as stagflation. It was not just an economic event, it became psychological. People began expecting prices to rise, and once that expectation settles in, inflation can become harder to stop. Today's economy is different, more diversified, more digital, more efficient. But the dependence on energy never disappeared. It simply became less obvious. Because modern inflation hides in complexity. Instead of a dramatic shortage, it can appear as small increases everywhere at once. And that may be more dangerous, because people often react too late. By the time most households notice a pattern, their spending power has already been reduced. And spending power is really what this story is about. Not just prices, purchasing power. Because a paycheck can stay the same while life becomes more expensive. That creates a strange kind of financial erosion. Nothing visibly crashes, no giant emergency sirens, no dramatic headline in your kitchen, just the slow realization that the same income buys less. That is how many economic shocks actually feel, not like an explosion, more like pressure. Now layer one more problem onto this: the Federal Reserve. If energy-driven inflation pushes prices higher again, the Fed could face a familiar dilemma: raise interest rates to control inflation, or avoid tightening and risk letting inflation spread. Neither choice feels comfortable. Higher rates can cool prices, but they can also slow borrowing, slow housing, slow business investment, slow consumer spending, and that means one disruption overseas can eventually influence mortgage rates, car loans, and credit card costs here at home. That is where the story becomes bigger than oil, because Hormuz is not just an energy story, it is a household finance story, a monetary policy story, a consumer behavior story, a confidence story, and confidence matters more than people think. When consumers feel uncertain, they spend differently. When businesses feel uncertain, they invest differently. When markets feel uncertain, they price everything differently. And sometimes uncertainty itself becomes the economic event. That is why traders watch Hormuz so closely. Not because every tension becomes catastrophe, but because the consequences of miscalculation can move fast. A missile, a naval confrontation, a tanker seizure, an insurance spike, a shipping delay. Any one of those can create a chain reaction. And in a tightly connected economy, chain reactions rarely stay local. They travel from shipping lanes to commodity markets, to transportation costs, to corporate earnings, to inflation data, to consumer budgets, until eventually someone standing in line at a grocery store in Arizona wonders why cereal suddenly costs another $2. Without realizing the first domino may have fallen in a waterway half a world away. That disconnect is what makes the system feel surreal. Americans often imagine personal finance as something deeply personal: budgeting, saving, investing, debt, retirement, and it is. But personal finance is also geopolitical. Sometimes your monthly budget is influenced by decisions made by people you will never meet in places you may never visit. That can feel unfair, because it is. But it is also reality. The modern economy is not built on distance anymore. It is built on exposure. And exposure means events far away can become intimate very quickly. The broader risk is not just one temporary price spike. It is repetition. If global choke points become recurring pressure points, households may face a world where volatility itself becomes normal, not one crisis, but a pattern of crises, each one shaving away at stability, each one making planning harder, each one forcing families to adapt again. That may be the deeper issue, because people can survive one expensive month. What wears them down is uncertainty. Not knowing whether next month gets better or worse, and that uncertainty can reshape how Americans think about money. Less confidence, more caution, less spending, more fear. Sometimes entire economies slow because millions of households quietly become defensive at the same time. That is how a narrow strait can influence a massive nation, not through drama alone, through psychology, through pricing, through systems, through invisible connections most people never see. And maybe that is the most unsettling part of all. For all the talk about financial freedom, independence, and control, many of the costs in your life are still tied to forces completely outside your control. You can budget carefully, invest wisely, avoid debt, build savings, and still wake up one morning paying more because a shipping route on the other side of the world suddenly became unstable. Which leaves a harder question: if a 21-mile waterway can quietly influence what millions of Americans pay for everyday life, how many other parts of your financial life are being shaped by risks you do not even know you are carrying?